Hi, I'm Peter Rose, founder of Longwood Currency Trading, and this is an important video, I think, for those of you who are trading Forex and probably have less than maybe a couple of years of experience. Many times in my previous videos, I've stated that we don't have to trade or know about the news, any news about Forex or what the countries are doing or whatever. We're not economists. We don't have PhDs in economy or economics or rocket science or any of the other stuff that maybe some of the large trading institutional houses have available to them, and they're trading for a different purpose than we as retail traders are. So I've said many times, we don't need to know anything about the news. However, there's a thing that people confuse with news, and that's the economic indicator releases that come out. Economic releases are whether the jobless rate is increasing, employment numbers. The main one is interest rate policy. There's housing starts. Those kinds of numbers that come out. They're numbers. They're not like, oh, well, we think that such and such is going to happen because, whatever. This is what happened in the past. The housing starts are doing this. The interest rate policy was maintained through that last rate decision. Those are economic indicators, not trading indicators. And though you don't have to be an economist in order to understand or use these economic indicators, you do have to be aware of them. So when you open your trading platform up, the first thing you need to do is to check what the economic indicator release schedule is for that day. And if there's been some in one of the pair countries that you trade that happened off hours from when you were at the desk, you need to look back in time and see what that number was. For example, today we had the UK came out with their interest rate policy numbers, and later in the morning from the US was a lot of jobless and employment figures. So if you were going to trade pound dollar, for example, then you would have wanted to be aware of those things. When you have high value economic indicator releases, the volatility of the market goes freaking nuts. When the interest rate policy came out from the UK today, for example, this is Feb of 2026. I think the market went 50 pips in like a minute. And then when some of the jobless numbers came out through the US, that took the price in another little jostling movement. Not anywhere near as great, because the U.S. had already come out with their interest rate policy decision last month. And so here we are looking at a reflection of the past that caused the interest rate decision to be made that they were aware of. Now, the next interest rate policy decision is going to be based on the numbers that we're accumulating between now and when that interest rate decision is done. And that's the same true for all the other countries as well. But these economic indicators will indicate volatility spikes, particularly, as I said, the big ones. They're probably, depending on the country that you're studying, there could be as many as 4 major numbers that you're going to want to know about. Interest rate policy, housing starts, joblessness, that sort of stuff. A purchasing manager's index is another one, or purchasing manager orders, or the prices, consumer price index, which is better stated in the maybe a different indicator. So there's four. They're not necessarily called the same thing in the different countries, but they measure the same thing. And so you just need to be aware of what those are. And you pull up your trading platform and you look at them and you say, is this a high value indicator that's going to come out? Did the other country have a similar indicator? When did that happen? What's the differential between the two? And how does that affect my particular currency that I'm going to be trading? How's that going to affect the pair? Because if one pair, for example, today in the pound dollar, the big dog of the day was their interest rate decision. That dwarfs everything else that's going to be going on. And so there was a tremendous movement in regard to that. So if you were trading and thinking of going long US dollar and this thing came out, you did okay because they didn't change their interest rate. So the US has other positive things going on, and the dollar reacted very positively toward it. If you weren't aware of that coming out, that economic indicator number coming out, you would have been sitting there looking at a chart that said, oh, this looks like pound dollar should go up today. And I've got, I got a 10 pip, 15 pip spread on the upside. I'll go for 8 pips, and you're jockeying around with all that stuff. The number releases and you're 50 pips underwater right away. That's what happens. So not only can't you trade the news, but you can't trade the economic indicator releases, but you have to be aware of them. You don't need to be aware of the news because, as I've said many times, a currency market is like this big ocean liner going down the thing, and all these news releases that come out don't affect the ocean liner's path. In the long run, over a 4-month period of time or 3-month period of time, that you'll notice that maybe that major trend of the pricing in your currency pair is going to change, but it isn't because of the news that came out right now. It's because of the news that's been compiling itself all along, and all that news is going to be reflected correctly in the economic indicator numbers that come out. The news is hearsay. Oh, I think, and it should do this, and blah, 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 blah. You don't want to fill your head with that shit because you don't have to know it. The guys that are trading institutionally, they have to know that stuff because they're placing their client orders into that market. That client is going to say, I don't want to pay more of my currency for this, and I've got to control my costs here. So the trader has to be aware so that they can advise that client, say, hey, look, Bob, I'm sorry, but if you don't go in and grab this price now, you're going to be paying a hell of a lot more for it probably 2 weeks from now because whatever. So you're putting an order in for $300 billion worth of stuff, and it's going to affect your per unit price of your sale by 8 cents. And so therefore, over your whole order, you're talking, maybe $600,000 a differential in what you're going to lose as a result of making that wrong decision. So the institutional trader has to be aware of all that stuff. As a retail trader, we don't. We don't have to speculate on what we think is going to happen. All we have to do is look at the chart. And when we're looking at the chart, it has to be in with the current economic indicator release numbers, not last month's joblessness report. You're combining, and the platform should show you this. Last month it was this, the consensus of opinion is it'll be this, and the number comes out and it's that. So you need to know what happened last month, but you don't, because the trading platform or the service that you use to check these numbers is going to give that to you. Last month it was this. The consensus of opinion is this. You make your decision up when you sit down at the trading platform and you say, man, there's a disparity in, let's say, jobless claims and job openings and interest rates. And you're going, I don't know what's going to happen. Great. Stand on the sidelines and don't trade. Let the thing go 50, 60 pips because you could catch that on the wrong side. So you don't need the news, but you need the economic indicators. And you can't trade them. You just simply need to be aware of them because they create volatility spikes. You don't know what that volatility spike is going to do because of the confluence between these indicators that come out. And if you get contrasting indicator values from each of the two-pair countries that you're trading, it's jump ball as to what's going to happen. So do you want to be a jump ball trader betting the farm to take a 40 pip loss on a $50,000 account? You want to take that $2,000 hit? Is that what you want to do? I don't think that's where you want to be. And you can't say, well, in the long run it should do this. Well, yeah, but what if it doesn't? Now you're $8,000 down. What are you going to do? Oh, I'll sleep on it. I'll carry trade with a float behind it. Well, that'll do you really good. It's just, that's not how you trade. But it's also not how you trade by looking at that news and trying to ferret stuff out, or planning your trading around the economic indicator release. Just stand on the sidelines to do that. The characteristic of that is non-farm payrolls, right? You shouldn't be trading non-farm payrolls. No, not even the experts don't trade non-farm payrolls. The institutional traders aren't doing it. They're not going to put a $5 billion order in there unless they're really firmly convinced of all the stuff that went around it. And then they can take advantage of that. But you know who they're taking advantage of? Us, the retail traders. They're going to stop punch it. That's all that's going to happen. And you'll see thing will move 50 pips up, and then it'll come back down 25, 30 pips. They got you. Well, why not? They've got the resources to do that. You can't compete with them, so why are you in there doing that? Just stand on the side and have a cup of coffee, which is what I'm doing right now, because all the numbers came out. I thought I'd be a hero. I thought he'd be on the right side of it. I took I think it was a 20 pip hit and 18 pip hit, or I got out, and then we'll see how the rest of the day goes. But I'm not going to go in there for another 15 minutes or so to look and see what's going on, because I'll go, oh yeah, I'll go back in. No, that's not the way that you do that. So you have to be very, very careful about what you're listening to out there in video land, what these people are doing. You can't sit in a vacuum and trade price action by itself, because these economic indicator release values are coming out every day. Whether it's the base currency or the quote currency. Doesn't make any difference. You have to be aware of both of them. But each one of them is coming out every day, and they have weighted values to how much volatility that could create. And there's a confluence of them that is a probabilistic estimate of volatility. So you look at the two-pair countries, and if any one of the, call it the three major ones, because your interest rate policy stays stagnant for a while, so that now you can worry about job values, for example, how many job openings are there. You might check housing starts, but the other country may not be an industrialized country, and so housing starts doesn't mean anything. They're not building any houses or whatever. So, but everybody's got a jobless issue. So you look at those indicators and determine for yourself, well, what are the three that I should be really aware of what's happening? And if either of the countries has one of those coming out, just stand on the sidelines while it goes out. You don't trade an hour before the release, and you don't trade an hour after. That's it. And if you're in the U.S., 8:30 Eastern time is when most of those numbers come out, 8:30 or 10 a.m., something like that. You catch those numbers. So, depending on where you live in the U.S. or in the world, you just go, I'm just not going to trade that. And that might be one day a week where you're not making those trades. And then you have to decide, do I trade Mondays and do I trade Fridays? There's all those decisions to make. Those decisions are based on your overall trading plan and your certain trading metrics that you have as to whether you're going to do a Monday or a Friday trade. And there's reasons why you have to consider that stuff. This is all stuff that nobody really talks about because it's a complicated subject and nobody is able to make it simple. It's like a lawyer will simplify a 5-page document into a 30-page document. That's their idea of clarity and precision. So don't kid yourself. The news, forget about it. If you want to be entertained, study the news. That's fine. And if you got a really good memory, then you're going to remember what's going on in the news between those two countries as they come up to some of these major economic releases, because ultimately the validity of that news is filtered out and results in the economic indicator number that comes out. So if you've been forming opinions as to what should happen, then that's fine. You form your opinions, just don't trade them. But you can study the news releases of the two countries, and you can form your opinions as to what should happen when the jobs report number comes out. How many new jobs are being created? And you've studied this news, and all of a sudden, when the jobs numbers come out, it isn't what you thought it was. Well, now you could say, well, what was in the news that would have alluded to that? Well, if you know what you're looking for, you can find it. But if you don't know what you're looking for because you don't know what the end result economic indicator number is going to be, then why bother study the news to form opinions to trade on? You can't. You can look at the news if you want. It's very confusing and it's very opinionated. You go to one channel where they're doing news and you read it and the guy has an opinion, and you go to another it's a TV channel, a podcast, or whatever it is that you're looking at, and the other guy has another opinion. And some of their opinions are 5 years out or next quarter or something. Well, that doesn't do you any good when you're trying to bid ask on a 5-minute chart. So on the one hand, there's people that are saying, oh, you got to know everything. You got to know the news, the economic indicators. You got to know blah, 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 blah. Got to know all that stuff. And then there's other traders on the naked side, naked Forex, which is no indicators and just trading price action. And both of them are wrong. It's more apt that you're going to trade price action, but there's more to it than just watching what the squiggly line is going to do and doing a probabilistic analysis. And that's what I try to deal with in my fast track course. It's a 6-week course. And we get into, it's all probabilities. So where do you form the probabilities that you get that are high, as opposed to the probabilities that are just, yeah, maybe that'll happen. It probably will. That's not a probability that I'd want to put my money on. And so the rules that we construct in the fast track program adhere to what I call the life cycle of a currency position, which is a ripoff of my 33-year career as a software engineer, designing really complex problems using the software development life cycle, the SDLC. And I just took a rip on that and said, here's the life cycle of a currency position. What is that life cycle? It's entry analysis, position management, and exit methodology. Those are 3 phases that the price goes through when you have a trade on. You have to know how to enter it, you have to know what to do with it while it's running, and you have to know when and how to get out. Okay? So each of those phases is a problem. And it can be solved with one rule. If it needed 2 rules to solve it, we'd break it up into maybe a 4th phase. But there's 3 phases, there's 3 rules. That keeps it simple. Why not just have one rule for the phase? Well, how do you do that? How do you write a rule? You write conditional-based rules. If this is true, and this is true, and this is true, and this is true, that's a digital yes. The rule should always throw you off a digital value. And then you look at the probabilities of the actual execution of that in the current market environment. So each rule comes with a set of conditions. Those conditions are in sequential order, so you don't have to balance, I'm looking at the moving averages versus the RSI today, but tomorrow I'm going to put more emphasis on the RSI and the Bollinger Band. So that just becomes a clusterfuck. So the rules, there's 3 rules, they're in sequential order. Each rule has from 2 to 4 conditions, really simple, and those conditions are in sequential order. It doesn't get any easier than that. But if you try to clutter that stuff with news releases and new economic indicators and, oh man, I'm going to look at what this Bollinger Band is doing today, you're just going to screw yourself up. And that's the hardest job I have in taking on a trader to join the Fast Track program is I have to change the way that they think about what they've been doing, because what they've been doing hasn't been working. And the only way to change what's not working into what's working is to throw away what's not working and start learning a process-oriented method of looking at price action by solution of sequentially solving the problems of entry analysis, position management, and exit methodology. If you'd like to chat about any of this stuff, as I say in every video, send me an email. I'd be happy to respond with you. No pressure on taking the course. Don't care about that. Said that a zillion times. Have a great day and have a great trading day.